Trading is not going to make you rich. I know that's not what the guy with the rented Lamborghini told you, but the math doesn't care about his thumbnails. And in the next 9 minutes, I'm going to show you exactly what trading can do for you, which if you stop chasing the fantasy is actually pretty good. By the end of this video, you will know 3 things. The actual numbers behind why most retail traders lose money, why 30% a month gains is mathematically impossible, and what would be the realistic version of what trading can do for a normal person who's not trying to buy a Ferrari or a Lamborghini. I'm not telling you this from a high horse. A few years ago, I was the guy chasing the dream myself. My first interaction with EAs ever was a $3.99 expert advisor black box that I bought from an Instagram ad, 50% discount code. Of course, I funded the account with $1,000 and in a week time it made me $100. So I added another $1,000 to the account. 2 weeks later, another $200 of profits. I called my wife and I told her I think I was going to retire soon. Then, I topped the account up to $10,000. Guess what happened next? The market reversed. I was down 50% in a matter of 2 weeks. After a little bit of research, I came across the term martingale and immediately knew what was going on. This is when I decided to close every trade manually, before the whole account is blown, so I could sleep at night. The mistake? I was so blinded by the outcome that I totally neglected the process. The lesson? We should never use an algorithmic system without knowing how it trades and manages risk. That's the trap I want to pull you out of today. Because the dream you've been sold isn't just unrealistic, it's mathematically impossible. Let me show you how. So let's start with the part nobody on Instagram talks about. The actual numbers. In Europe, every CFD broker is legally required to publish how many of their clients lose money. The number sits between 74 to 89%. That's the European Securities and Markets Authority. Every broker, every quarter posts on their own website because the law forces them to do that. In the US, the CFTC tracks forex accounts. Their answer is 70 to 80% of US retail forex traders lose money. The number doesn't move. Australia did the same study before they tightened their leverage rules. They found their retail CFD traders collectively lost over $770 million in a single year. That's one country. 3 regulators, 3 continents. Same answer. Most retail traders lose money, and the number is remarkably consistent. Now, you might be thinking, okay, that's the average trader, and the average trader is bad. But I'm not an average trader. I've got a strategy, and I'm profitable. I'm going to be one of these 11%. So let's look at the top of the food chain then, because that's where the math gets really uncomfortable. Let's start with the most famous investor alive, Warren Buffett. He's been running Berkshire Hathaway since 1965. 60 years of compounding. 60 years of access to private deals nobody else gets. His average annual return on that entire run is around 20% per year. Not per month, per year. You might say, Buffett is a value investor. That's not really trading. So let's go to the GOAT of quantitative trading. Jim Simons, Renaissance Technologies, the Medallion Fund. Simons was a literal mathematician. He hired PhDs in physics and statistics to build a fund that's widely considered the greatest money-making machine in the history of finance. Their average annual return between 1988 and 2018 was about 39% per year after fees. Now let's do the math on the Lambo guru on Instagram claiming 30% profits a month. Compound 30% per month for 12 months and you get a return of 2,229% per year. That means that the guy with a rented car on Instagram is claiming casually to outperform Warren Buffett by 112 times and to outperform Jim Simons, the greatest quant trader of all time, by 57 times. Either he's the most important financial mind in human history, just casually posting about it on Instagram between Lamborghini photos, or the math is impossible. I will let you decide which is more likely. So let's kill the myth of these unrealistic gains once and for all, shall we? Every holy grail you've ever seen worked for a while. I will admit that. The Lambo guy isn't making it up. He probably did make 30% at a certain month. The screenshots are real. But then, one day the account is gone. Why? Because no edge in trading lives forever. The strategy that prints money in March bleeds out in June. People who get sold an outcome have no idea what's happening when the outcome stops. That's exactly what happened to me with the black box EA I mentioned at the beginning of the video. It was a martingale strategy. It doubled down on losing trades without equity stop loss. The strategy wasn't winning, it was just surviving. The moment the market trended against it, the doubling down amplified the loss instead of recovering it. The problem wasn't the expert advisor or the algorithm behind it. The problem was me. I bought the outcome without understanding the process. Watching some guy on Instagram post 30% monthly gains and thinking that's going to be your future is like watching Slash play guitar on a Guns N' Roses concert and thinking you will be on stage next week because you just learned your first chord. Aspiring is good. It's actually very good. But aspiring without being factual about the gap is how you end up broke. Once you understand why it always ends this way, you start asking a better question. What does trading actually look like when you're not chasing a fantasy? Quick thing before I show you the realistic version. If any of this makes sense to you, smashing this like button helps this video reach out the next person who's about to do the same mistakes I've done in the past. That's it. Let's get into the plan. Now the Lambo dream is dead. Good. Here is a more realistic ladder. 3 steps. None of them require a holy grail. Step number 1. Aim to fund your personal trading account with $10,000 of your own money. Then optimize a trading strategy that could get you 1.5% profits on monthly basis. That's around $150. Sounds small, but 1.5% a month is roughly 2 times what the S&P 500 returns on average. You would be beating the most recommended investment on earth by a factor of 2. That's actually really good and doable. Step 2. Prop firms. This is where the math gets asymmetric. You risk a small evaluation fee from the money you made from trading on your personal account for the chance to trade an account 10 or 20 times bigger. Same boring 1.5% suddenly pays $400, $800 or even $1,000 a month. Not because your strategy got better, but because your capital base did. Then you stack those accounts and run the same boring system in parallel. Step number 3. Take those payouts and grow your own account. Most traders I know spend their payouts or recycle them into another challenge, which is great. There is nothing wrong about this. But move some into your own personal account as well. Grow it over time. Remember, unlike the prop firms, your personal trading account have no drawdown rules, no compliance clauses. Just you, your trading capital, and your decisions when it comes to trading. Rinse and repeat this process until you reach a sizable trading capital. And suddenly, this $150 per month become 1,500 or even more. This might not seem much to you and it will definitely not buy you a Lamborghini, but it could pay your mortgage. It could pay your utility bills on a monthly basis. In fact, this amount would replace salaries in so many countries around the world. If you ask me what would be the most common quality successful traders have, I would tell you that they are the ones who figured out that real trading is boring. And it should be. Let me show you. This is one of my own accounts running Grit, one of the most sophisticated expert advisors on our platform. About 61% growth over roughly a year, with a maximum drawdown of 14%. That's an exceptional year, by the way. Almost 6 times better than the S&P 500, better than most hedge funds on earth. But look at these dips. The last one I did not recover from since Jan. And you know what? I am so happy about it even, because that drawdown is an evidence that no edge lives forever. The regime shifted, and it's time to re-optimize. That's the actual job. Boring maintenance on a system you already know it works. Here is the rule I live by when it comes to trading. If you are excited or frustrated by your trading strategy, you're doing something wrong. Both mean you've drifted from process into an outcome. Real trading feels like nothing. It feels like checking on a house plant. Now you know that it's all about the system and the process, and this is why I believe in quantitative trading through algorithms. Watch this video where I uncover the truth about algo trading and why, in my opinion, it's way more superior than manual discretionary trading. See you next week.